All right. So yeah, we just had a report today from payroll report, and that payroll report basically said that we have a very strong employment situation, and some 10 here. Okay, so we look at this, the 10-year, and we'll look at the 2-year. Okay, the stock market's basically following this. We've been saying that for like 6 months now. Okay, so there it is. The 2-year and the 10-year are both up. Basically, there was a strong employment report. So we were rooting for a very poor employment report. Then the Fed would not raise as much. But right now, we have a very strong labor market and wages are increasing. And the dual mandate for the Fed is maximum employment and price stability. So this is one of the major things that the Fed looks at for determining if they're raising rates or not. And okay, so the 2-year went up because if there's a strong employment report, the Fed will have to raise rates more in order for the economy to cool down. So the strong jobs report says that the economy is still strong. So it looks like, based on what the employment report was today, we're going to be meeting on the 14th. They've already said they're going to be tapering earlier this week. The Fed said in the statement, we're not going to be raising as much at the next meeting, and the market rallied because of that. So that was really good. But these strong job report may mean that we have more interest rate hikes in the future. So we're going to be mapping out these next Fed meetings. There's futures for this, and it seems like there's at least a 25 basis points in January, and they might say something in March. We're done. We've maxed out and then the stock market will go up. So let's see. One thing that Walter Deemer said is, he said, the only thing that you have to predict is when the end of the recession is going to be. 3 months before that, the stock market will rally. So there's going to be a slowdown in the first couple months of the year for sure. January, February, March. That's why it's all yellow here. We don't know what's going to go on, but the economy's going to slow down. That could go way into May, maybe, but 3 months before the end of the recession. So that's the only thing we got to predict. That's when the stock market the bull market starts. All right. So let's look at some of our numbers we always follow, and we always look at these same talking points for the stock market to go up. We had some really good news. One is Powell signaled slower pace for rate hikes. That was the first non-hawkish talk that the Fed had in a long time. And it wasn't that great. We've been predicting the market's been predicting 50 basis points for months. It's nothing new. I don't know why the stock market rallied this week, but so that he signals slower pace for rate hikes. The 2-year and 10-year went down until today. Went down 5.5%. After it went up today, it's probably down. It went up down 3.35%. So this is really good for the stock market. Whenever the treasuries go down, it's a very good indication that the Fed is not going to raise rates as much. Okay, so we don't have earnings until January, basically. Most of the next batch of earnings are going to be at the end of January. So that's why, well, we don't have that to look forward to for a catalyst at all. Okay, we're currently overbought, and that's not a good indication. It's usually an indication to go down. And the other things, okay, so we didn't have a whole lot of things that would affect this. The only big thing that made the stock market rally on Tuesday, or Tuesday or Wednesday, was the statement by the Fed. So, revealing our major variables. Crude is up a little bit. There's talk of OPEC cutting and the opposite of that. And there's a Russian cap on oil that's happened. It's too much for us to predict, but we were saying when it was over $100 a barrel that in a recession, oil was 70, or 60 or 70 a barrel because there's less demand. So if we're going into that, it's going to be really, I'm not sure how safe it is to be in an energy. Let's look at the energy sector right now. Okay, so we're still in an uptrend in the energy sector. But in all the stocks, most of the oil stocks are still low PE ratio, high dividend, which is kind of what's been working this whole year. How long will that last? I don't know. But at some point in time, the leaders of the past will start working too. So a lot of times whenever one sector does really good in the year, this is one of the best performing sectors of the year. This becomes the laggard, and the losers from the other year, for this year, become the leaders. So it's still in an uptrend. You can see it's still making higher highs, higher lows. Until that changes, it seems like we're still in that pattern. Right, so dollar is unchanged. We're rooting for the dollar to go down, and that's really good for the big multinational companies. It's been going down. You see, let's look at it's been going down in a pattern, a channel. So it looks like that's good for the stock market, because if it continues to go down in this pattern, then stocks, when they report next quarter, will have much better earnings, maybe 10% better than expected. All right, just because of the translation of currency whenever you have overseas sales. Okay, so let's see. Let's look at let's look at the sectors and see what's happening with the sectors. We know, what do we know now? One's going down the most: semiconductors, technology, oil. Okay. Let's look at, the price of oil is down 1% today. Natural gas down 4%. Corn, commodities going down. That's good for us, because that's a very good indication that major commodities going down. That's good for inflation, and that'll make this better for the stock market. Let's look at, we looked at that. Look at what sectors are doing good. So that explains why the oil sector is down today. Why is the technology sector down? Why is it down? Well, because the interest rates, whenever there's the good employment report, that means the Fed will raise interest rates more. And the higher the interest rates, the worse it is for tech stocks. That's why the financials down. That's why tech stocks are down. Let's look at, I think there was some bad news about a company like Marvell Technologies. They're a chip company, a supplier. The price of oil is down. That explains that. Home construction. Interest rates going up. That's less people can afford houses. That's why housing is down. Okay. Financials are down because banks don't make as much when the yield curve is inverted. Let's look at what's doing good today. Mining, services, retail, biotech. Okay, let's look at the biotech IBB. This is the ETF for biotech sector. Let's look. Wait. Okay, last year at this time, we were looking at the biotech as the one that's underperformed. And let's look at this year. Let's go back 2 years. So it's the beginning of this year. Okay. So at the beginning of this year, we can't see. It doesn't give me dates. Okay, so last year at this time, the biotech and the healthcare sectors were the worst performing sectors. And this year, there it is. This year they're up like 5%. So they're probably one of the better performing sectors. So at the end of every year, we like to look at what did good in the last year, what did bad in the last year, and a lot of times people reallocate and choose different sectors. And let's see, the healthcare, what else? Consumer staples. Okay, these are pretty much high dividends and conservative sectors right now. Ones that are down the most are interest rate sensitive sectors. Okay, so this is all having to do with the US 10-year and the 2-year. Both of them are up, and the sectors follow after that. Okay, so now let's look at the S&P. This is pretty important. Okay, so I traced the tops, the bottoms. We're in the channel. We're at basically the top of the channel, and we've been making higher highs, higher lows in this channel here. It's a very interesting. We're kind of stuck here. We're not breaking through. I found a lot of our stocks we're watching are starting to break through this downward channel. Today is a very, very important day. If we could find a way to make some progress to get out of this downward channel, you can see that 200-day moving average is pretty close. And when a certain number of stocks are in the market go over the 200-day moving average, it's a good indication that there's momentum and the stocks will start going up. We'll keep our eye on this 200-day moving average for every one of the stocks we're following and indexes. You can see, let's look at the 200-day moving average is this purple one here. And you can see every sector is still below that. And, except for this one, materials. It's starting to get above the 200-day moving average. And there's a lot of investors that only get in whenever the majority of stocks in the market are above the 200-day moving average. And that is an indication that we're in a positive market and we're in a new bull market. But we're not there yet. We're still in the downtrend. But you can see there are sectors that and stocks that are starting to break out of the channel that they're in. See. Okay, I'll go over some of those in my meeting notes. All right. Okay, so we're still overbought. Stochastics are overbought, and we're coming to the time in our in our meeting notes, we're coming to a time where the market's basically going to either go down or it's going to mark time before the Fed meets. Because whatever they say at this meeting basically dictates the way the market's going to trade for the next couple months. And the same thing with this meeting here in February and the one in January. So right now it seems like there's nothing exciting going to happen for a while. But we have to, let me see. Okay, we have to keep an eye on these channels because they're very powerful, and right now, until further notice, we're still in a downward channel, and the next stop is down here. And if we have good news from the Fed on the 14th, we could get out of this downward trend. And it's the DXY is basically unchanged since last time. Fear and greed. We're just about the same as last week. People are still greedy. And there's a very good chance that there could be a fear of missing out situation where if there's some good news at any of our points that we've been waiting for these points to evolve. If there's any good news for these, we could have a fear of missing out rally because there's a lot of money on the sideline. So, and there's greed. People are greedy. And whenever you have greed, you have fear of missing out. And a lot of people sold at the lows, and they might want to get back in when they see things going up. So that's just the basic investor psychology. The VIX, it's down since last week. It went below 20. You can see the VIX is in a downtrend, and that's good for the stock market because that means investors are less fearful. There's less quick buying. There's less fearful. The volume is better, and there are less fearful plays in the market. And this one guy wrote a message on Twitter. He said, "Breaking VIX closes below 20 for the first time since August of 2022." So fear is completely gone, the guy says. So we've been saying, we have this little chart up there. If the VIX is 10 to 20, it's kind of a bull market. People are not afraid. And there's like a fear of missing out. People are greedy. Right now we're kind of on the edge of bull market and complacency. When you have a lack of fear, then they bid stocks up without fear. All right, so we're going to go back to Walter Deemer's comment. He said bull markets traditionally launch 3 months before recession ends. He said, if you pay the economist, this is all for his research. All he would want is when the recession is going to end, and that's 3 months before that is when the stock market will start going up. So he said, starting to see forecasts of a recession starting next year and lasting a few quarters, maybe till the end of the year, or until the beginning of next year. So if it's, let's say, the recession is over before January, that means October or September. September will be the month when the stock market is bottom. So we'll keep that in mind. It's not written in stone. It's not something that works every time, but he's a really smart guy. This is one of the biggest news stories from Tuesday. The stock market went up 3 to 5% for major indexes. But he was not telling us anything new in his speech. Everyone had it mapped out that it's going to be less rate hike in December than the last one. So that wasn't the new news, but he was more dovish tone this time. So dovish means they won't raise rates as much, and or they're going to be more accommodative and provide monetary resources. Hawkish is they're going to raise rates and try to take away activity in the economy. And this is what Jim Cramer says. Fed's power inflation remarks are a green light to stay in stocks. For what that's worth. Okay, so the Senate approved the bill enforcing railroad labor agreement before the strike deadline. Okay, so what this, the lesson learned here is that it's almost, well, I have a railroad stock, and I'm not afraid of strikes because rails are so important to America that the president always steps in, and there's always some kind of resolution. So the Congress stepped in this time, and they ended the strike. And but railroads have a monopoly, and they will never build another railroad. Their thesis is they get more efficient over time. The real estate that they have for railroads is worth far more than the market cap of the company. And I don't think the Congress, the president, will ever allow a national shutdown of railroads. So if you ever see railroads or a stock that's a true monopoly, maybe like Google, or selling off, then that's a good time to start looking at those sectors. Because unless there is something major causing the thesis to change, this is a very stable environment, very similar to trash collection. There's always going to be a need for that, and there's a monopoly. And all right, so let's look at another little article that I saw in Barron's. If anyone has any comments, let me know, and I'll go over some things. There's a letter, the note Barron's about how to set up a bond ladder. Mark was saying last week about how he's setting up bond ladders, and I said, well, that'd be interesting to go over that. And okay, you can read the article, and in the article they went through some ETFs that you can buy for a bond laddering situation. And I listed these ETFs in the article here, but this is an example of what a bond ladder is. It's basically spreading out maturities of bonds over a period of time, so that, you know, as interest rates go up or go down, you can buy new bonds when they mature at a different rate than when you bought it at, and that's basically allows you to lock in the rate, and then as rates go up, and you know they're going up another % this year, then you would get a better rate in whenever you go to maturity for that bond. So bond, usually you can invest a couple ways into bonds. One is an ETF. What Mark uses is individual bonds, but individual bonds aren't liquid. You can't go to TD Ameritrade and buy an IBM 8% bond or a municipal bond from Southern California. You actually need to get make a phone call to a bond desk and make a trade. That's kind of the way that industry is. I think TradeWeb might be changing that. I don't know, but last I checked 10 years ago, you still had to make a call through a broker to do that. But here's an example of a bond ladder. Say right now we have $1 million to invest in a bond part of your portfolio. Immediately you put 40% in a treasury yielding 4.22%, and that matures in 1 year. We know in a year it's going to be higher interest rates than today. Well, we don't know, but it's probably going to be. So in 1 year, that 1 year treasury matures, and you can buy a 1 year treasury for a high, let's say, for the sake of example, that the Fed raises interest rates like at the end of January, and they raise it 1%. And so in 1 year, and let's say it raises another So in 1 year, you can get that same treasury at a higher interest rate. And as long as you hold a bond to maturity, you'll get back what you paid, the face value of it. And plus the mature, whatever you, the premium, not the premium, the interest you get from the bond. But sometimes you pay a little bit more than the face value, and that's called a premium. And whenever, what a bond ladder is basically, it's just spreading out purchases and expirations of your bond part of your portfolio so that you get a consistent, steady amount of return. It's guaranteed as long as the underlying security is okay. And as the interest rates change, you can get better rates. So this is an example of a 20-year. Let's do another example. If you buy a 20-year municipal bond, and let's say you paid $10,000 for it, and it's 20-year. If the interest rates go up, that $10,000 you paid for that individual bond, municipal bond, is worth far less. That $10,000 is only worth like $9,000 after the interest rate, if you want to sell it on the open market. And if the interest rates go up again, then that $10,000 is worth $8,000 if you want to sell it. So that's called, it's worth less because if the interest rates go up, then you have the value of that security goes down. But if you hold this to maturity, it's still going to, and everything's okay with the municipality, you'll get what you put into it plus the interest. I don't know if that makes any sense, but it's really complicated if you're trying to get in and out of individual bonds, because the par value, or the value of the security goes up and down based on interest rates. And that's why it's kind of dangerous to hold a bond fund, because as interest rates go up, your bond fund usually, the value goes down. All right. So any questions on bond ladders? All right. You usually do this if you're in retirement and you need like 4 or 5%. You got a good nest egg, and you want a guaranteed 4 or 5% in retirement. And then you would do this so you were guaranteed a certain amount, and having them mature at different times allows you to adapt to changing environments. All right. Okay, there was a CNBC Power Lunch with an interview with David Katz. And I wrote down the important parts of his talk. He says the market likely is pricing in a coming recession, and the rally off the lows means we're looking at a modest recession. So the Fed will be dovish, not raise as much next year. Inflation is getting under control in his viewpoint. He thinks the stocks will have basically no growth next year, very little growth, but they will still go up because of PE expansion. So the price-to-earnings ratio of stocks go up, but the earnings don't. And that's what happened all of last year during the COVID pandemic. Just like Apple didn't grow; it grew 5%, but it went up 40% last year. That's called PE expansion. And he gave an example of the COVID crisis in 2020. The market had a great recovery, but they were looking beyond the temporary slowdown. Everyone knew that with the economy shut down, that there was going to be a problem with earnings. But the market looked beyond that to a time that there was a recovery. That's almost exactly like what's happening right now. So you basically switch from defensive, which is the dividends, healthcare, oils, a lot of the more paying dividend stocks to offense whenever the sell-off happened earlier this year. So he got more into aggressive. I'll show you his portfolio a little bit later on. He says lots of good companies are down 40 or 50%. He likes classic tech growth. Amazon, Google, Medtronic, Truist Financial are his favorites. He says Amazon, he sees 30% to 40% higher in the next year. Google is a great company with great long-term prospects, only a PE of 17. Medtronic, he says there's a 30% upside and has a 3% yield. He likes banks too. I'm going to go over a couple of his picks next, just to see if, what he's thinking. What I did was I went to this site here. This is a hedge follower. He runs this hedge fund called Matrix Asset Advisors. And here are his top holdings. What I did was I highlighted the ones we're following in green, and the ones in yellow are the ones that are down from when he bought them. So he bought them at times, you see, 10 to 40% from where they are now. So PayPal is an example of one. It's down 33%. Paramount, Medtronic is down 25%. So what I did was I looked at some of the yellow. We've already been following the ones in green. What I did was I looked at some of the ones like Comcast, Truist Financial, that are listed on his ones that are down the most. So let's look at some of them. The Truist Financial, they're a financial company. I guess the good thing about this company is it pays a 4.5% dividend, which looks pretty secure. It has good numbers for the return on equity and the profit margin. And its PEG ratio is 1. So it is fairly valued. And so right now, if you look at the chart for Truist, it's like in this sideways trading range, like a dividend stocks we've been following. It just goes, right now it's close to the low end of the trading range. And David Cott said that he said for banks, that this stock has a P of 9, 4.5% yield, and they do good in this environment because, they're attractively priced and very good companies. All right. So let's look more at this Truist. Okay, so we see it's in a pattern here. It's close to the bottom of its range right now. So this is very close. It's halfway between overbought and oversold. Let's look at the financials going forward. Shows a 5% growth. That's not that great. And there's not a whole lot of analysts covering it. It only goes out 1 year. That doesn't tell us a whole lot. So if it's growing at 5% and it's a P of 9, that means it's 2 times overvalued. If we could trust these E-Trade earnings estimates, that's not so great. It is making less this year than last year. So so that's pretty inconsistent. But okay, so that we need more information from we like to have 3 or 4 years out to really be confident, and higher growth rate than 5% to be interested. But it seems like a very stable company that if you're interested in a 4.5% yield, this looks pretty reasonable. Okay, so let's look at Comcast next. Comcast is another one of his favorites. It's down 14% from when he bought it. The PEG ratio is 0.73. According to Yahoo, it's 30% undervalued. So return on equity and profit margin isn't that great. So Comcast is a business that they're an entertainment business. They do internet and media. So they own a lot of media companies, and they sell the service of internet, which it's very high maintenance and a lot of capital involved in, like they have to go in and install, maintain the lines down. So there's a lot of money involved in maintaining a line, just like the phone companies. So that's probably why their profit margin isn't that great. Their total debt is $97 billion, and their current market cap is 158. So that's another reason why most likely this stock is down. Let's look at the stock. If you look at its stock, it goes back. I took this is the 5-year chart. Where it is right now is where it was in 2017. So this is an example of very strong support at this level. Where it's at right now is 36, 32. So every time you can see that there's a consistent amount of times in the past where it bounced, from this level where it's at right now. So, but the big problem for Comcast, most likely reason for it to be down is it has a lot of debt and has to refinance debt in a higher interest rate environment. And this is a very good portion of the market cap. It's almost 3/4 of the market cap is debt. It has a dividend yield of 3%. So the total return, let's look at the earnings estimates we see. Okay, Comcast earnings estimates, 5%, 12%, 11%. Let's say it's 10% growth. PE of 9.44, growth of 10. That's a fair valuation. That's like a PEG of 1. So they have a lot of debt. They will have problems refinancing. And the stock will be punished in a high rate environment. So the higher the interest rates go, that's like a cap. And that'll keep the stock pretty much. It's going to be hard for the stock to go up whenever the interest rates continue to rise. I guess I forget what company they bought. They bought some kind of media company, maybe NBC or something like that. I'm not sure. But they still are working off a lot of debt, and they have a 3% dividend. So that if you're interested in dividends, that's pretty secure. And they're at the low end of their multi-year range. So let's look at another Medtronic. This is another of David Katz's favorite stocks. I tried to look at why I would invest in this. Let's see. It's growing around 6% a year. 5% from this year. To divide these two numbers together, that's 5%. Then I get 3%, and then 8%. So that's not that great. So it's around 6% growth. And you see, PEG ratio is 2.41. Okay, so it's not that compelling. Report PE is 14. We expected it to we expected it to grow 14 PE, growing at 6. So the PEG ratio it's pretty expensive, and it does have warts. There are problems with this stock. They have issues, and I don't know if I'd want to get into this. Let's look at the statistics for this. PEG ratio, this it's close to what we predicted. We said 2.41 because it's growing at 6%. They think it's 3 times overvalued. And the profit margin, that's good, but the return on equity isn't that great. We'd like 13 or above. So right now this is pretty ritzy stock. It has a dividend, 3%, so it's not that exciting for me. I put out a little list right now of stocks that are breaking out of long-term downtrends. And we've been following this religiously, these downtrends for each of these stocks. And every time it hit the top of the range, it went down. Hit the top of the range, went down to here. And all of a sudden, we see a couple breakouts. I don't know if this is a true breakout or not, but I'm seeing them on a regular basis now. Like last week we only had 2, and this week we have a lot more. So let's look at some more of the alphabet. I don't want to make a big deal about this, but it's starting to break out of this downward channel. And let's look at some more. Bristol Myers was in a sideways, and it's starting to form an upward channel now, and higher highs, higher lows. CSX is a railroad stock, and it's been in a downward channel for a while, and it just recently started to break out of that. JP Morgan is very similar. It's actually a couple weeks into a breakout. And Procter & Gamble, another stock that has been in a downward channel for over a year, and now it's starting to break out, so it's making a new channel upward. MasterCard, another stock that has been in a downtrend that's starting to break out. So it's just these, but the main index is S&P 500 is not breaking out. If we look at the S&P, we're still at the top of this range. We haven't broken out of that yet, so we're keeping an eye on that. And until further notice, we're still going in a downtrend. All right, so eBay is another stock that recently broke out of that downtrend. Boeing, another one. NVIDIA, you can see it right here. It broke out, and it's starting to make an upward channel. Now, all this stuff that we're following here, it's not perfect. I mean, there are some people that follow this. Majority of big money does. But if we had some bad news that affected the stock market, these charts, you can just throw them away because it doesn't matter. But they only work in downtrends, uptrends. But whenever there's a sell-off, you can just throw it all out the window, and then you start looking for support. So if we look at, take an example of the S&P 500, and let's look at levels of support, just so we can prepare ourselves for a sell-off. Let's say, okay, 5-year. Let's look at some levels of support. Whenever the stock market corrects, right now we've gone up 12% in 2 weeks or 3 weeks since here. That's a lot. But whenever you have this support right here, you have to go back to where there was resistance before. Past resistance is now support. But every time it bounced, it bounced, it bounced. That's your support level for the next leg down. So if we ended up a huge sell-off for whatever reason, we'd have to go back and look at some of these past levels of support right here, COVID lows right here. Let's go back even further. We can see that there was support here in 2018, and that is what allowed the COVID lows to hold, because that was basically support from 5 years from then. But that's what you do in a sell-off. We're not there yet. We're not there at this time, but I just want to bring that to your attention. Let's look at the 2-year and the 5-year. They're still okay. They're not going up as much as before. All right. So I think the stock market's basically following the 10-year and the 2-year, because these were up a lot more than they were right now. Look, it's going. You can see for the past couple of weeks there's a downtrend. You see what we had. So the rates have been going down. So if it continues to go down. Yeah, let's look at some more of my talking points here. Nike is also breaking out of the downtrend. Here's an interesting news story. You can't really take every news story for. You can't believe everything you read. So this stock SQM they're a lithium producer, and their earnings soared 941% on surging demand. So I know Mark invests in Albemarle and ALB, and if you like the theme of lithium, this is a stock that's one of the largest producers of lithium, but it's basically hasn't done anything for a year. It's been sideways. So I thought that'd be interesting to look at that stock. Let's see, the forward PE is only 5. The PEG ratio is 0.14. That means Yahoo Finance thinks it's 7 times undervalued. These numbers are just awesome. 77% return on equity and profit margins. Wow. So I looked at the earnings estimates. And let's do the quick calculation there. Hold on. 13.19 divided by 14.09. So it's growing at 7% from this year to next year, and then it goes down after that. I'm not sure why, but I expect that if they're growing at 900, we saw a big growth from here. 2 to 13 is an amazing amount. I'm thinking that that could have been because of the electric vehicle revolution. You know, we had a lot of new demand for lithium, but right now it looks like the earnings are going down for the next couple of years. So that might have been true for, this quarter to quarter, but I don't see the estimates aren't going up in a straight line like we want. So right now we'll ignore this 941% surging lithium demand article. If I find something else, I'll let you know. But right now, it doesn't look like it's going up in a straight line. The earnings estimates. We always have people on both sides of the coin for the economy. We know this guy Mohammed Al Arian. He was a famous bond investor for. I forget the name of the company, but anyway, he always has he's an economist. He has a really good understanding of how the economy works, and he says that we're in trouble. Central bank tightening, pressures on supply, and market fragility is going to weigh on growth. So it looks like we're going to be basically flat or not growing a whole lot for the next year. A lot of people are saying that. So I guess if we're planning for next year, we got to have some kind of dividend, or if we're not growing, the economy is not growing, then it'd be very wise to have a certain part of your portfolio in at least stocks that are paying dividends. So he thinks the economy could go sideways for a year. On the other side, we have a guy that says the market could soar to new records in another 1982 style vertical rally. This guy from Fundstrat said basically in 1982 that when they started fighting interest rates, the inflation basically dropped like a rock, and he expects the same thing to happen now. And he said that could mean inflation is already on the way down, eventually prompting the Fed to ease up. So he's on the indication that in the next 3 or 4 months, the inflation will be over and we'll start growing again. But he thinks the market will sense that that's going to happen and start going up. He expects it to go up before the end of the year. So you have to read both sides of every situation. Another article about a Santa Claus rally for stock is likely that you won't be opening presents until after Christmas. I think I might have said this before, but the seasonal good time of the year is after Christmas, not before it. So I have it green here, but usually this is the best time of the year for investing. Maybe because of end of quarter window dressing, they have off their holidays, and maybe I don't know. Statistically, this is the only week of the year that really matters. And okay, let's look at just to get in touch with our emotions. People are starting to get greedy. We saw the greed and fear index has been greedy for the past 3 weeks. And we've had a stock market that's gone up 11%. And it's just whenever people are super greedy and we're hit with some kind of news story, and that'll knock everyone down. And they'll be fearful, capitulation. We might just have another COVID drop like this. We can't predict it. Best we can do is just find out if the stocks we're following are still fairly valued, and has any of the investment thesis changed. This is very similar to how Nike dropped. Let's look at an example of Nike, because we were following Nike. Where is it? There it is. Okay, so we were saying, right when it was around $80, $87 a share, the theme for Nike is that they're growing their direct-to-consumer business, which has higher margins. They're a dominant. They have a monopoly? No, not a monopoly, but they're a dominant seller of foot gear in the world. So they have and they have a really good name in management. So whenever you have that situation where retail was, you're afraid of the consumer coming back, and the stock is selling off like this, you have to be willing to maybe step in and buy a little bit at a time, and get into a stock that's consistently growing. And Nike is an example. We were showing back then, a couple of weeks ago, that they're still growing, estimated to be growing at 20% for the next couple of years. So this is an example of, we're not at fear or capitulation. Now we have a VIX that's going down. So we're still delusional. And new paradigm, maybe by the end of the year, we'll have people worried about a recession. And then we have the front page of every news story. Fear of recession causes panic and capitulation. And you can't get too involved with that. For me, I have stocks that I'm comfortable in, and I know that are consistently growing. They're projected to grow in a straight line up. And if you have a capitulation, it's not what you have to figure out what the stock is worth, not what it's trading at. So we'll be here someday soon. I don't know when, but we're going to have capitulation and fear. So you have to, if you're afraid of that moment, maybe it's not a good time to be invested in 100%. So, but I don't let these emotions get into my way. All right, so let's look at average stock market returns. We know the last 3 months of the year are good. That's a very good indication that December is going to be a decent month. And I think that's all that I had to talk about. Any questions? Anything anyone to talk about?